Finance often relies on the illusion of perfect mechanical precision. We assume current data can chart the exact trajectory of future interest rates. This chart displays the spot rate curve, the yield of zero-coupon bonds across varying maturities. It's the fixed income baseline. We can extract a second line, the forward rate curve. Mathematically, a spot rate is simply a geometric average of current and future forward rates. But extracting that math leads to a dangerous assumption. Active bond portfolio management is built entirely on the premise that this current forward curve will fail to accurately predict future spot rates. If spot rates evolved exactly as predicted by forward rates, bonds of all maturities would realize a one-period return equal to the one-period spot rate. There would be no mispricing to exploit, and active fixed income management would cease to exist. To find bonds that are actually mispriced, we have to deconstruct the yield curve. We use 5 traditional theoretical models to separate pure mathematical expectations from real-world market frictions. Success in the fixed income market depends on pinpointing exactly which market driver, be it rising inflation, shifting market liquidity, or institutional mandates, is responsible for the current shape of the curve. Under the unbiased expectations theory, the yield curve snaps into a perfectly flat line where spot and forward curves overlap. Rolling over 5 consecutive one-year bonds yields the exact same return as holding a single 5-year bond. The flaw in this pure theory is obvious. It assumes investors require zero compensation for taking on risk over longer time horizons. The local expectations theory offers a more constrained, realistic iteration of this pure math model. Instead of applying across all time horizons, it preserves risk neutrality only for short holding periods. Under this theory, in a narrow 6-month window, even a highly risky 30-year bond is expected to earn exactly the risk-free rate. The model acknowledges that risk premiums exist, but they only assert themselves over longer durations. Pure mathematical expectations effectively govern the immediate short end of the curve. To explain the behavior of longer maturities, we have to factor in human risk aversion. Under the liquidity preference theory, investors demand a premium to lock up capital, forcing the long end of the curve to pivot upward. We define this expanding wedge as the liquidity premium, which grows higher the longer you part with your money. This compensation is the primary reason why normal yield curves slope upwards in standard economic conditions. Active managers don't just observe this upward slope, they exploit its geometry to chase above-market returns. The strategy they execute is known as rolling down the yield curve. Here are the mechanics. A manager buys a long maturity bond. As time passes, it approaches maturity, physically moving leftward and downward along the slope. Its yield decreases, mechanically forcing the bond's price to increase, generating an excess return. There is a strict boundary condition here. This strategy only adds to the portfolio's return as long as the yield curve remains upward sloping. The term premium is the physical manifestation of investor anxiety, transforming time itself into a tradable commodity with quantifiable price action. Yet real-world yield curves are rarely perfectly smooth. They frequently display bizarre, localized spikes and dips that pure risk and time preference fail to explain. The segmented markets theory addresses this by completely rejecting the idea of a seamless, interconnected curve. Under this strict framework, long-term and short-term yields are entirely unlinked.
The shape of the yield curve is dictated purely by isolated interactions of supply and demand within specific maturity buckets. A softer, more realistic compromise is the preferred habitat theory. This theory recognizes that market participants have specific maturity zones they prefer to operate in, but they are not permanently trapped there. A pension fund naturally prefers the 30-year habitat. It has a rigid, structural necessity to safely match long-term assets against decades of future liabilities, but they will deviate from their preferred habitat if compensated adequately. If the 10-year segment suddenly offers an anomalous yield premium, that pension fund will abandon its 30-year preference to capture the excess return. Institutional mandates create structural rigidities that frequently override pure mathematical logic, resulting in localized inefficiencies that active managers can isolate and exploit. Beyond internal market structures, there are 2 massive macroeconomic engines that drive physical shifts in the yield curve's shape: monetary policy and inflation. The division of influence is clear.
Monetary policy explains 2/3 of the variation in short and intermediate-term yields. Conversely, inflation expectations explain 2/3 of the variation in long-term yields. When central banks raise short-term rates to combat inflation, it triggers a bearish flattening. The spread between short and long rates decreases. We call it bearish because this action signals an economic slowdown. The inverse of this action is a bullish steepening. Here, the short end drops sharply, and the spread between short and long-term rates increases. Central banks trigger this steepening by cutting short-term rates to support economic growth during recessionary times. Portfolio managers align their exposure. Expecting a rise in rates, they lower portfolio duration. If they expect rates to fall, they extend duration. This requires structural rotation. On the left is a bullet portfolio, heavily concentrated in a single maturity segment. On the right is a barbell portfolio, heavily weighted at the extreme short and extreme long maturities. If a manager expects a bullish flattening, meaning long-term rates will decline in a flight to safety, they will rotate out of a bullet portfolio and into a barbell portfolio to capture the impending price appreciation at the long end. These theoretical frameworks allow traders to anticipate how the curve will react to the economic cycle, turning abstract concepts into actionable duration strategies. When we bring these elements together, the true nature of the term structure reveals itself. It starts with a flat expectations baseline, builds a slope through the liquidity premium, and absorbs localized distortions from segmented habitats. The raw forward rate curve is a mathematically pristine baseline, but it is practically flawed as a predictive tool. The actual curve you see in the market is an equilibrium of pure math, human risk aversion, rigid institutional mandates, and central bank interventions. Because these forces interact constantly, a bond's current market price frequently disconnects from its theoretical value. This exact disconnect is the sole justification for active portfolio management. An investor's edge lies in correctly identifying which specific theory, or friction, is warping the curve at any given moment. Mastering the term structure requires treating the forward rate as a point of departure. Success in bond management depends on identifying exactly which market friction has disconnected the current price from its mathematical baseline.